Hello and welcome to the Quarterly Context webinar for the third quarter of 2018 for clients of the Advisor Group and WealthStep. WealthStep is the online division of the Advisor Group that provides a simplified service for up-and-coming clients, as well as 401k plan participants. Quarterly Context webinars are designed to provide high-level perspective regarding the economy, markets, and investor behavior patterns, as well as other information, in order to help both our personal wealth and institutional clients better achieve their goals. We try to keep these webinars to about 20 minutes, and we'll circulate a video link should you like to view some portion of it again or pass it on to someone that you think it might help. And if you have any questions, please submit them to the question box. As always, we like to start with a reminder of the importance of focusing on your highest level goals first, and in particular, then the elements that you can control and what really matters. Whether it's market volatility or the weather, there's some things that can't be controlled, but your responses to those events and your long-term planning are things that you can control and therefore affect the success of your long-term outcomes. As a quick review of recent markets, while some of this may feel like long history now that the beginning of the fourth quarter has been a little more volatile. Looking at the third quarter and the prior year, the U.S. stock market was up about 7%, a very strong quarter that exceeds the full year expected return currently. And in terms of our 10-year market projections, international was a little more dampened at 1.3%. Emerging markets were down in great part due to currency impacts related to rising rates and the related impact on the dollar. Global real estate was flat for the quarter, as was the U.S. bond market and essentially the global bond market as well. For the year, quite a strong showing for the U.S. market, and flatter to less notable across the board elsewhere. Overall, in terms of market-related news, the Fed raised rates a quarter point, again making it the 8th increase in recent years. Short-term bond yields rose. The 10-year Treasury fell a little bit, but still remains around recent year highs. And the yield curve, as you can see here, going from 17 to mid-18 to late 18 is flattening out a bit, which implies a slowing economy. And if this short end ends up being higher than the long end, that's called an inverted curve, which oftentimes implies or precedes a recessionary environment. It's not clear that we're quite close to that yet, but there's some talk about where that might be on the horizon. Stocks were, again, relatively strong. Some unusual or interesting notes. Amazon at one point hit $1 trillion in valuation. I think it was Apple that was the first company to do so just a quarter ago. Facebook was a much more volatile stock given the regulatory data and other news, and dropped at 1.18% during the middle of the quarter. Overall, the stocks weathered tariff talks, and whether it was with China and the NAFTA-related stalled talks with Canada. Overall, again, earnings were solid, and stock buybacks, tax cuts, and low rates continue to push prices up, and some would argue that those the stimulative effects then may have created a bit of an artificial rise in the market, and then there are questions about whether it's gone a little bit beyond its reach. What some are calling the FAANGM stocks, Facebook, Apple, Amazon, Netflix, Google, and Microsoft, have been a big driver of returns, and we'll talk about that really pushing the majority of the market's rise recently. And then China, more specifically in emerging markets, was down 8% due to a sell-off in tech and their space, and that sector there was down 14%. So that's some nitty-gritty, but gives you some context for recent market activities. In terms of the news that affected some markets during the last quarter, some of the key things are shown here, but tend to be minor factors in the very long run. But in the short run, with the deficit rising and consumer prices rising somewhat, but eroding otherwise, increases in wage gains or jobless levels and unemployment being near all-time lows, while at the same time U.S. confidence remains high. These are some of the factors that have either buoyed or pulled back on the market during the quarter. For the overall economic snapshot, GDP did surge in the second quarter. Still, final third quarter numbers haven't come out, but are projected to be closer to the mid 3%. But some of this 4% surge in the second quarter was related to pre-tariff scrambles where, for example, China made major soy purchases that are front-loading some of this economic activity, so it may back off in future quarters. Again, we talked about rates, and additional rates are expected, another during this current year and another 3 in 2019 is what the Fed is projecting. Inflation remains tame, but there's some signs of it increasing, or the potential for increase, and that could make markets a little bit nervous. Currently at about 2.7, but more recent rates at about 2.9. Unemployment, again, the lowest since 1969 at 3.7%, and now at 95 or 96 straight months of consecutive months of jobs being added, and that's the longest in recorded history here. Wage growth also increased, but relative to that inflation number, you can see is essentially flat. So, and is below the 50-year average, which is why some people still are feeling the brunt of the global financial crisis aftermath. Consumer confidence, again, is strong currently. Sometimes that precedes a little bit of market volatility. People become complacent about markets, feeling like wealth has improved and will continue to do so. Oil is on the rise again after some bumpy early quarter prices, and sometimes this can precede some market volatility as well. Historically, some major market bumps have been related to energy shocks or stability, and sometimes that's related to supply or demand or both. Taking a peek then at a couple of drill downs on those economic elements, you can see the patterns long term here for unemployment coming down, wage growth coming up, but still not matching up enough. Consumer sentiment at a high we haven't seen in a while, going back to the early 2000s, early mid 2000s. Oil price, you can see the rise here that I've referenced a moment ago. Corporate profits are relatively high, which is what is essentially one of the key drivers that is buoying the market currently, despite some of the increased concerns about valuations. And inflation here remains tame, but is ticking up just a little bit. And the question is how much and how fast will that increase? In terms of valuations, you can see versus a 25-year average that the S&P U.S. large cap market is a little bit over that long-term average. And overall world markets are not too different than the 25-year averages. And while volatility's picked up more recently until or through the end of the third quarter, it had come down a bit. But again, the next quarter's numbers will show that pick up. Taking a look at valuations from a different light, here we can see the U.S. market, the international market, and the emerging markets relative to the solid line is their actual path, and the dotted line is the averages. So you can see going back about 15 years. So the You can see emerging markets and international are roughly around their averages, whereas the U.S., at least over the last 15 years, is a little bit over the average compared to the prior slide, which showed versus 25 years being a little bit less of a differential. As an update to the 4 bad bears chart, you can see the 4 worst markets in U.S. history in terms of their declines here and their recoveries. This is on a real or inflation-adjusted basis, and that's on that basis, the current blue market, global financial crisis, has had a very strong recovery and a little bit bumpy here in the last year or two, and newer numbers would reflect in October some additional volatility. On a before inflation basis, this smaller chart shows how the oil and financial crisis of the 70s was actually similar in terms of market measurements, but not as much of an increase if it's adjusted for inflation. So some volatility is normal after such a rise, and some would expect that to flatten out and eventually revert to the mean, either gradually, potentially gradually over time, with potentially a few other bumps along the way. The market expansion, or economic expansion, in terms of GDP growth continues, and we're just about to cross the mark of the early 90s expansion in terms of length. So speed, GDP growth has been a little more tepid in terms of magnitude, but length is right about the longest in history. The Fed, if we look at how the Fed responds to economic growth, here we can see the 2018, 19, and 2020, what we call the Fed dot plot, where the Fed Open Market Committee announces each of their individual rate forecasts, and as you can see, the pattern is rising rates over the next few years, and then in the longer run, sometime after 2020, rates coming back down a little closer to an average of 3% or a little bit under 3%. So that implies that what the Fed has expected in terms of their forecasted rates, but that longer term, it may be that some loosening may be required to support economic growth, either in the response to tepid or more significant pullbacks in the economy. In terms of whether or not we would expect a reversion to the mean, there's a lot of talk now with the market getting bumpier and such a long economic expansion. Some of the growth and earnings are still solid. As mentioned before, job numbers are solid, other factors are solid, consumer confidence. However, some other factors that worth considering in terms of tempering expectations are that some of the e-commerce companies are hitting some bumps in the road that they hadn't expected before or experienced, and that's increasing their costs of doing business. And in some cases, for example, with Facebook, has so far only been able to be addressed by human help and employment, which is a lot different than the scalability of their tech platform. So that's one of the things that caused bumps in their prices. Stock valuations, as talked about, are somewhere between reasonable and a little bit high. Oil prices are rising with supply inventories shrinking. That increases the susceptibility to shock a little bit. Share buybacks, low rates, and the tax deal are providing some stimulative support that otherwise would not maybe support the current prices quite so much. Central banks are tightening with rates going up, especially at least in the U.S. The yield curve flattening, as we mentioned. The junk bond market, or the high end of junk bond market, is an increasing portion of the investment grade bond market, so that implies a little bit more borrowing and therefore potentially a little bit more risk depending on the quality of the bond and the company. Inflation, again, is low but accelerating. Real wage growth, an issue. Tariffs and consumer and government debt have been creeping back up to pre-global financial crisis levels, although at lower rates it's a little bit easier to pay down that debt and service that debt. So there's no impending doom here, but there are reasons to expect more normal long-term or slightly sub-long-term returns on average, which are what's projected on average over the next 10 years. Speaking of 10 years, looking back 10 years, we are now at the 10-year anniversary point of the global financial crisis. So what are the lessons that were learned? Key things are that what goes up must come down, at least for a while. Patience pays. It's really notable and will be surprising to many that for someone that held a 50% bond, 50% stock portfolio, it only took 2 years for full recovery. This was the second worst market recovery in market crash in history. It only took 1 year for full recovery from the bottom of the market. So hanging on and having a risk-appropriate strategy relative to your life stage or your organization's needs are valuable and really where a lot of attention should be paid periodically over time, as opposed to getting overexcited about strong, frothy markets. There is a big opportunity cost to getting out at the bottom for those that got out here and missed these huge recoveries. That's very clearly the best way to lose is to not participate in the recovery. It's tempting to jump in and increase your stock exposure at any point late in a recovery because markets have been strong and sometimes, as is the case in the last 10 years, relatively low volatility. So it seems like high returns with very little risk. But as you know, risk does happen, and it's important not to get overexcited and exceed your risk tolerance, and better to focus on your plans and your strategy. Rebalancing adds value in that process as markets get volatile and you are repurchasing into stocks at lower prices that can magnify wealth over time. And key to focus on what you can control, key to get good guidance to make sure you're avoiding pitfalls, especially regarding behavioral finance and emotional responses to market activity. And the summary then is really that prudence and discipline pay in the long run. And it's key to start with the strategy that's appropriate for the needs of this stage of your life or your organization's needs, and then evolve that over time based on strategy, not based on emotion. Going back to some of the tech stocks, the FAANGMs, as some refer to them, there's an interesting comparison here of the rise of the percentage or market cap as a share of the S&P 500 here versus the pre-tech boom share. So some would say that the earnings and scale that have been achieved by the current tech stocks is more sustainable than some of the pricing valuation relative to earnings and profitability, lower earnings and profitability back in the late 1990s, but nonetheless still an interesting comparison. And if we look at the FAANGM stocks here, as of the end of June, the return of that set of 6 stocks represented 71% of the market's increase for that quarter, and about 25% of the return for the third quarter. And the FAANG stocks, a subset, were up in the second quarter 42% versus 4.8%, or about 5% for the overall S&P. So a small number of very large e-commerce, tech, and consumer e-commerce companies are having a big influence on the market. So with volatility picking up a little bit more recently, especially at the beginning of the third quarter, it can be helpful to get a reminder about what the patterns are of volatility, and that when it does increase, it's short-term uncomfortable, but important to ride through it if you're an appropriate strategy for yourself or your organization to make sure that you benefit from the gains. So here's the pattern of rises and falls, and naturally you can see here, while the drops are often feel more pronounced and certainly more painful, they are always smaller than the rises over time. So the average bear market was a 33% drop over 14 months, and the average bull market was a 268% return over 70 months. So you have to be in it to win it. And if you grow concerned and back out or back down relative to the strategy you need for your long run, you may be dampening your long-term outcomes. On the flip side, in terms of bonds, when the stock market is down, as shown by the gray bars here, the bond market tends to provide ballast and offset in terms of diversification to smoothen the ride. Taking a peek now at cycles, there are two cycles or market sets that are especially out of sync recently. Growth stocks have really dominated the last decade, but as shown here, the 10-year average of the going back 10-year rolling periods, the red shows periods where growth stocks beat value stocks, and the blue shows where value beat growth stocks. So in the long run, despite the recent 10-year patterns that are evident here, in the long run, value has an advantage and merits continual inclusion and even potentially a tilt, as we do to a mild basis in the portfolios to add a little bit of value, again, in the long run. 5-year numbers are similar in that regard. When you look at just 1 year, it looks like it's all over the place, and maybe even roughly an even trade, but on a cumulative effect, the difference is significant over those 10-year rolling periods. Similar charts, but different markets. Now let's take a look at profitability versus high profitability versus low profitability stocks. And you may think, well, why would anyone hold a low profitability stock? There were lots of those all the time, especially relatively new companies or temporarily downtrodden companies or tech companies that are investing more than their earnings might suggest, and reinvesting rather. And so, for example, can see that over the long run, companies that are profitable over a rolling 10-year period have always won, whereas in the short run, there are periods, including recently, where low profitability companies have had better stock prices, but despite being lower profitability companies. This relates also to the quality question that we sometimes discuss that we can look at now. And here we can see that for the quarter, whereas the last number of quarters has, for the most part, had an advantage, pretty clear advantage for low quality stocks, and over the last 10 years in general, as you can see here, where this periodic table of quality, we should say, year by year numbers showing, for example, the orange is the highest quality stocks, has tend to hover in the lower end over the last 10 years, and more so than the long-term average. In this last quarter and year, high quality is starting to, at least currently, outperform, and we would expect that to persist a little bit if volatility continues. The reason we mention this is that in portfolios we build, we blend in a combination of higher quality managers, and that can dampen returns in the short run when more speculative stocks are in favor, but tends to help portfolio returns in the long run by dampening volatility. Overall, cash flow patterns of the mutual fund industry can tell us something about investor behavior. Most recently, money has been flowing out of money market type funds and into taxable bonds right in time for some negative bond returns as interest rates are rising. So lots of patterns here about investors doing exactly the opposite of what long-term investing would suggest. It's better not to drive using the rearview mirror. For the 401k corner for the quarter, the key message is to make it easy for participants. The overall concept is that if you use pre-built, especially custom pre-built portfolios, you can increase diversification, decrease cost, and increase long-term results, both through the investment component, but also through minimizing the investor behavior component by having a pre-built portfolio rather than asking plan participants to invest in individual funds, which is oftentimes confusing conceptually. So a pre-built portfolio can give them a single one-stop option for their particular needs from a menu of pre-built funds. And interestingly, recently Vanguard actually removed the S&P 5 index from their own 401k plan, indicating that it was not an appropriate representation of the overall U.S. stock market. And so having individual funds that are too focused or not clear can confuse even people at an investment firm. So there are two major approaches to the pre-built portfolios: age-based versus risk-based. Age-based is target date, risk-based is a single static allocation or array of static allocation funds, and then there's off-the-shelf versus custom. And we're happy to discuss this further if you are exploring a relationship with the advisor group, or if you're a current client and debating on a switch between one or the others, which should primarily be driven by your plan demographics, and we can help you discuss what might be most appropriate moving forward. In the personal wealth corner, some elements related to life cycle planning. There are two major phases where the planning process can really help, and this goes far beyond the investment component. The investment component is really a piece in the bigger picture, but there's the accumulation phase and the decumulation phase, and a lot of the accumulation is about how much to save to achieve the retirement goal, spending goal, given the expected retirement date. And then there are actually a lot of interesting factors as well in the decumulation stage, whether how much to spend and when in order to not run out of money before you run out of time, smoothing of the experience of spending and lifestyle. Some of these things have changing statistics regarding longevity and spending patterns of people, and so good planning can really be helpful in terms of avoiding pitfalls as you're making decisions over time. There are a number of factors that can go into having an ideal long-term outcome. One element that's notable from longevity standpoint is that it's causing some people to work longer. So this shows different age groups in each line here, and how over time people have elected to work. A greater number of people are choosing to work into their later years. Some not by choice, others by choice, either for additional spending power or to follow activities that they prefer to stay active and feel productive. In terms of fiduciary, the fiduciary corner, an insight for this quarter is a concept called governance alpha that's relatively new in terms of the coining of the term, but not new in terms of what we have been talking about for a long time. This is different from investment alpha, which focuses just on the portfolio, and governance alpha really has to do with how fiduciaries make decisions that can impact plan participants and their retirement readiness. That can relate to plan design, the investment structure, behavioral finance, education, tools, advice elements, and so forth. And there are a number of things to focus on, but as fiduciaries, for those that are fiduciaries, really are expected to focus on more than just the investment. So one of the key starting points is to challenge your assumptions and see where you can increase your impact and really focus on what moves the needle. As a quick update in terms of rules and regulations, the DOL after the SEC after the DOL terminated the fledgling DOL fiduciary rule that was started during the Obama administration. The SEC is now intending to create some sort of fiduciary guidelines that would make for a more consistent and transparent experience for financial consumers. In general, I think that's good news, and however, it could be a little confusing if states are doing that individually without a clear, consistent approach and guidance. Also, the Fed seems to be expanding its definition of big banks, and it's not clear whether or not this, if size and threshold is relaxed, this could be part of a broader wave of reduced regulations that could historically at least lead to greater financial shocks in the future. A few notes here on the 401k self-directed space in terms of litigation, in the 403b space, and a new student loan employer match program the IRS approved. So a few things to pay attention to there. Almost lastly here, reminder for personal wealth clients, there is a lot of value added potentially in the loss harvesting process. So when markets are volatile, a good advisor will periodically review for opportunities to actually sell securities at a loss and replace them with similar securities so that the asset allocation and market exposure remains intact. And then in order to harvest, what's called harvesting those losses, to bank them and use them against future gains, so it can be a powerful way to reduce the tax impact, and that is something that you don't see inside the returns that might show in your quarterly reports, but it definitely shows up on your personal balance sheet in terms of improving overall wealth. Interestingly as well, the tax deferral effect and the tax bracket arbitrage effect of the benefit of essentially getting a loan from the government and deferring taxes, and the shifting or taking advantage of more near-term higher taxes if you're going to be in a lower bracket in the future, can really have a significant impact over time, as shown by some of the charts here. And we'd be happy to talk to you about this individually at any time you like. So with that, I want to thank you for attending today. We look forward to any questions you might have one-to-one or through the question box for the webinar. But please contact the advisor group and your advisor should you have any questions or concerns or would like to explore any topics. And we are also always very appreciative of those that have referred clients. Here is an outline of our typical client size and type and space. And again, thank you very much for your time.